Hi, Professor. Myself, Alvin. So, my case is Target Canada, and we're going to be talking about the lessons from a failed global expansion. I'll show what went wrong, connect, connect to global marketing theory, and finish with three CEO level action targets should have taken and how these lessons apply to future international entries. Introduction to Target Canada. So Target is a US discount retailer known for its cheap cheap. In 2013, it entered Canada aggressively with 133 stores in under 2 years, and by 2015, it completely exited after billions in losses. So today I'll focus less on the brand's history and more on the strategic and operational choices that drove failure using frameworks we covered in classes. So as you can see, this chart literally suggests Target entered a crowded, price-sensitive market, while Walmart definitely dominated value retail. Costco and Canadian Tire were entrenched. Amazon was accelerating online beyond competition. Canada's geography raises logistics costs and complexity. The strategic implication to win here, you need either cost leadership through supply chain excellence or clear differentiation. So Target launched with neither, and consumer, uh, so Target launched with neither of them, and consumer expectations were high because of the US halo. So Uh, so when it comes to market entry strategy, Target chose an acquisition-based rapid rollout by buying sellers, leases, a capital-heavy path that prioritized speed over learning. From a theory lens, the Uppsala internationalization model favors gradual commitment, pilot, learn, adapt, scale. Target skipped the learning loop. The locations acquired weren't always ideal. Remodels were rushed, and the organization didn't build Canada-specific supply, pricing, or assortment muscle before going national. So the entry mode itself amplified execution risk. So when it comes to specific challenges faced, we're going to be using the satisfaction that is expected versus actual line chart that I've created. So there's three visible failures followed. So the firstly, it's supply chain and IT, like empty shelves, poor inventory accuracy, and slow replenishment definitely was a huge challenge. And pricing and value perception, Canadians compared prices to US targets and felt let down because there was higher prices and thinner selections and brand promise gap. So the cheap chick experience didn't materialize in Canada well. Okay, so this chart captures the expectation to reality gap. Consumer excitement at launch fell as stockouts and price disappointment persisted. In a price sensitive market, trust eroded very quickly. So culturally, Canadians tend to be less tolerant of uncertainty. And expect reliability. So persistent stockouts and inconsistent pricing were especially damaging. Per Hofstede, when uncertainty avoidance is higher, operational hiccups aren't forgiven. So also Canadian shoppers are value oriented. They don't buy the brand story unless availability and price match. So Target Canada's offer didn't meet those norms. So that's why it led to a bit of challenging apartment for the company, and it went into a threshold, and because of that particular reason it didn't go through very well. So here we're going to be talking about the biggest competitors and Porter's five forces. So Target's biggest competitors here was Walmart, firstly. Though Porter's five forces, Through Foster's five forces, that is rivalry high, Walmart, Costco, Canadian Tire fight hard on price and scale, and buyer power that was also high. Canadian consumers are price sensitive with many alternatives, and supply power was quite medium that targets largely US centric sourcing didn't translate smoothly to Canada, and threat of substitutes was very high because Amazon and specialty retailers, provided easy alternatives, and threat of new entrants was low because they were capital heavy, but incumbents already owned cost and convenience, and Walmart's cost leadership and supply chain strength created a moat Target couldn't cross. So yeah, that's the reason. Okay, so when it comes to pestle environment scan, uh, from a pestle angle, political or legal, least constraints from the Zeller's deal limited flexibility in site choices and timing. Canadian compliance and import process added friction on that, and economy post-recession value mindset meant pricing mistakes were punished. About social, it's high loyalty to Walmart and Canadian Tire. Expectation sets by US target marketing didn't match the local reality. And when it comes to technology, Target, underinvested in e-commerce and omni-channel, which is which is far below than the Amazon and local leaders. And environmental and logistics, Canada's spread out population raises transport and inventory costs. So these external factors magnified Target's internal execution gaps. So yeah. So when it comes to key learnings, there are three takeaways. So speed without learning is costly, and pilot first. And localize, like supply chain, pricing, and assortment must fit the market. And align, it should align brand promise with delivery, like value and availability are non-negotiable in Canada. So yeah. So if I were CEO, or if I could rewind, I will go for launching pilot 5 to 10 flagship stores in Toronto, Vancouver, Calgary, or for 12 to 18 months, measure in stock, price gaps, NPS, and then scale. So this follows Uppsala, that means learn before committing, and build a Canada specific supply chain, like dedicated DCs, localized vendor domains, and a pricing architecture that closes the US Canada perception gap. That's classical global supply chain adaptation. And the go omni-channel from day one, that is robust e-commerce, click and collect inventory visibility, leverage digital to compensate while physical execution matures. So yeah, that's the things that um, I'm planning to do if I get a chance to do it all over again. Okay, so for future foreign markets, Target showed, stage entries, that is pilot to learn to scale, which is tied to hard KPIs, and localize the value equation, that is price, pack sizes, assortment, and promotions. Lead with digital, that is by digital I mean use online to validate demand and reduce inventory risk, and also build local partnerships where they speed learning or fill capabilities gaps. So yeah. Okay, so in conclusion, Target Canada was not a marketing slogan problem. It was a strategic execution fit problem. Risky entry mood, insufficient localization, and a promise that operations couldn't keep. So the broader lesson for global markets balance, standardized with deep local adaptation. So move deliberately and make that supply chain the first product. So that's the key aspect of these things. And if yeah.